This is a special edition of your Money Briefing for Friday, April 14th. I'm J.R. Whalen for the Wall Street Journal. On this episode, we're taking a closer look at those mortgage rates, which can pave the way toward moving into a new home or price buyers out.
So hopefully they come back down for people, yeah. We have 2 kids that eventually will need to buy houses, and I just don't see with the current rates like how that's ever going to happen.
So where do you begin the search for an attractive rate?
When you are getting a mortgage, you're definitely not committed to that national average. A lot of bank websites will allow you to browse the different types of mortgages that are offered and the rates that they're offering. And real estate agents will often offer referrals to local lenders too.
My guest is Holden Lewis. He's a senior writer at NerdWallet who focuses on mortgages and home buying. Hey, Holden, thank you for joining us.
Hey, thank you.
So first of all, Holden, help us with the basics here. What are the different kinds of mortgages out there, and what kind of an agreement does the borrower sign?
There are 2 main types of mortgages. There's the fixed rate mortgage and then adjustable rate mortgages. And north of 90% of borrowers get fixed rate loans. So, what that means is you're paying the same interest rate over the life of the loan. Usually that's 30 years. And so your monthly payments stay about the same. With an adjustable rate mortgage, the interest rate stays the same for the first few years, usually 5. And then after that, the interest rate can go up and down every 6 months. So those are the 2 main types of mortgages.
All right, but wouldn't it make sense then to sign up for the fixed rate mortgage and have the same amount every month, so there aren't any surprises?
Deciding on whether to get a fixed rate mortgage or an adjustable, which is also called an ARM, it's really an issue of personal temperament. You or I might prefer to avoid the risk of our mortgage payments rising along with the interest rates. But a lot of gamblers are out there, and they prefer to get the lower payments now on an ARM with the possibility that rates and payments could drop in a few years. And in the meantime, those folks are saving money. One of the advantages of an adjustable rate mortgage or ARM is that the initial interest rate is lower than what you can get on a fixed rate mortgage. And therefore, you're saving money in those first few years versus someone who got a fixed rate loan.
And then what happens to that more attractive interest rate?
Let's say you get a 5-year ARM. The interest rate stays the same for the first 5 years, and then it adjusts up or down every 6 months after that. And it's pegged to something called SOFR, the Secured Overnight Finance Rate. And so lately, that has been going up. It's gone up pretty steeply. It's gone up about 0.6 of a percentage point so far this year. So someone who got a SOFR 5 years ago, they would be seeing their interest rate going up right now. But we don't know what's going to happen in 5 years. It's possible that interest rates could be falling 5 years from now. And someone who gets an ARM now might actually see their interest rate go down when it starts adjusting in 5 years. We just don't know. It's also very possible that that rate could be going up in 5 years. So ARMs are really well suited for people who think that they're going to sell the home within a few years, or someone who is just kind of starting out in life. They think that they're going to move in the first 5 years or so because their family is going to expand or they're going to start earning a lot more money. That might be worth the gamble because they expect to get out of that house in a few years anyway.
All right, then with regard to the fixed mortgage rates, each week, it's usually on a Thursday, we hear about how the average 30-year mortgage rate ticked up or down over the past week. What does that mean for prospective homebuyers?
So you're talking about the Freddie Mac index, and it's really good for tracking the trends, just whether interest rates are going up or down. But don't expect your lender to offer exactly the rates reported in Freddie Mac's weekly survey. And that's because the survey is conducted early in the week and then it's reported on Thursdays. So first of all, the data might be stale, but also that survey mixes rates on loans with discount points and without discount points. With a discount point, it's an upfront fee that you pay to the lender to reduce your interest rate. Usually, 1% of your loan amount will reduce the interest rate by 1/4 of a percentage point. So let's say you're getting a $300,000 loan. If you pay 2 points, that would be $6,000. That would be 2% of the loan amount. So you'd be paying $6,000 up front, and you might reduce your interest rate by about half a percentage point. And that can really save you a lot of money if you keep that house for, say, 5 or 6 years or longer.
So when someone does go down the path of discount points, is there room for negotiation there?
There's not room for negotiation with an individual lender. But what you can do is apply at several different lenders. 3 is a good number. And find out the deals that they're offering on discount points. And one of those lenders might be offering a better deal on that day or even at that hour. So that is the best way to shop for the best deal on discount points. You always keep in mind as a buyer that the negotiation isn't only about the house price. The negotiation can also include elements of the financing. So you can actually ask, you can just proactively ask, hey, to the seller or to the home builder, will you please pay some discount points? Home builders are a little bit more eager nowadays to offer discount points because, frankly, there's just more homes being built and being completed than there are homeowners who are putting their houses for sale. You can also negotiate on things like your move-in date or the homeowner's move-out date, and things like, can you store items in their garage before they move out? All of these things are subject to negotiation. So don't get stuck only on the price.
Now it's time to start the search for the best mortgage rate. Coming up, we'll discuss when it makes sense to use a mortgage broker and hear from homeowners about their journey. All right, so how should people begin the search for a mortgage, and are they beholden to the national average? Here's more of my conversation with NerdWallet's Holden Lewis.
When you are getting a mortgage, you're definitely not committed to that national average. So a good place to start is just online. A lot of bank websites or a lot of sites like NerdWallet will allow you to browse the different types of mortgages that are offered and the rates that they're offering. And real estate agents will often offer referrals to local lenders too. And the real estate agents, they're not really looking out for you in terms of finding a lender for you who offers the lowest rate. What the real estate agent wants is the lender who is responsive, offers good customer service, and above all, is the most likely to actually close that loan. Someone who's thorough, who isn't going to come up with nasty last-minute surprises, because, that's not what real estate agents want to happen. They want that loan, that closing on the house to go through on time.
And Holden, Lindsay from Clifton, New Jersey, who we heard from earlier, really crystallized the importance of finding a good rate against dealing with all of their other expenses.
And so for us, it was all about having a good, efficient person. It didn't matter to us what bank it was through.
We often hear about mortgage brokers in the home buying process. What exactly do they do?
Mortgage brokers look for a mortgage for you. A broker has relationships with multiple lenders, so they can take your application information and then shop that information to multiple lenders in search of the best deal. That's different from, say, going to your local bank, where you make a mortgage application and you're applying with just that one lender. Mortgage broker just simply has these relationships with different lenders, and they can look at different what are called rate sheets, which are the rates offered, but also with fees taken into account. So they take your application information and apply it to those different lenders, and they search for that best deal.
Why would somebody use a mortgage broker, and why would somebody not use a mortgage broker?
People would use a mortgage broker because they might have a really complicated financial life. That's one real big reason for using a broker. For example, let's say you're self-employed and you have a pretty complicated tax form. Mortgage brokers, they can spend more time assessing your financial position, and they know which lenders are willing to do a loan for someone with kind of that complicated financial life. For people like me who I have a job, I get a W-2 form, everything is really straightforward. That's kind of a plain vanilla mortgage. I can get that at a regular old bank. I could find one through a broker. But if I were self-employed and I had a company vehicle and I had tax deductions related to that and all sorts of complex ways to just count what my income is, a mortgage broker might be a better bet.
How would a prospective home buyer using a mortgage broker, how would they be charged for the broker's services?
The mortgage broker works on commission. So they collect a commission from the bank. That's really not all that different from, say, a loan officer at a bank who gets paid a salary. And those costs, those commissions, or those salaries, essentially, you end up paying for those when you close the loan in terms of fees and the mortgage rate.
So going through the process of getting a mortgage, is it common for people to work with more than one lender, and should they do that?
Absolutely, people should apply with multiple lenders. There has been research on this. Freddie Mac has conducted it at least twice, where they find that if you apply with at least 3 lenders, you tend to get a better deal than someone who applies with just one lender. We're talking about lower mortgage rates. We're talking about lower fees. So the advice is to always comparison shop. It's a good idea to apply with at least 3 lenders and or brokers to find the best deal.
And so that comes down to the competition between the lenders and the brokers?
That's right. There is competition. Some lenders just charge more and some charge less. And really, that can vary day to day and even hour to hour. It's a very fluid market. And so the best thing to do is not only to apply with at least 3 lenders or brokers, but also to try to do that in the same day, because those different mortgage offers, they change day to day.
But Holden, ever since home prices began to rise significantly, it's been rough for first-time buyers. Are there programs geared toward them to help make this process a little smoother?
There are a lot of programs for first-time home buyers. Some of them aren't specifically for buyers. I'm talking about the VA, which is a program administered by the Department of Veterans Affairs, and FHA loans, which are loans that are insured by the Federal Housing Administration. Those mortgages are good for people who might not have high credit scores, like something below 720, and they offer really good deals as far as minimum down payments. You don't have to make a down payment on a VA loan, and the minimum down payment on an FHA loan is 3.5%. So on top of that, every state and Washington, D.C., and some big cities have first-time homebuyer programs. They'll give you grants or loans to cover your closing costs, or they might offer subsidized mortgage rates.
All right, that's NerdWallet's Holden Lewis with us. Holden, thanks very much for joining us.
You're welcome. It's my pleasure.
Finding the best mortgage is a big piece of the puzzle, but there's still plenty of room for error. Next week on the 4th episode of our home buying series, we'll discuss costly and common mistakes made by buyers and how to avoid them. And that's it for your money briefing this week. We were produced by Ariana Osperu and Mohsen Ali. Today's episode was mixed by Jess Fenton. Our supervising producer is Melanie Roy, and our executive producer is Chris Zinsley. Editorial support provided by Philana Patterson. I'm your host, J.R. Whalen. Thanks for listening, and have a great weekend.